Okay, guys, today is August 1st, 2025. We have about 50 minutes until the market closes for this Friday. Again, it is August 1st, 2025. We had a doozy of a day. And as I have been alluding to before and previous video, I said the banks are insolvent. And I want to go over today the Deutsche Bank really, really quickly. And I know they reported earnings and painted a very, very rosy picture. But as long as they hold a 10-year U.S. Treasury bond, they are essentially insolvent as well. Really, none of the problems from the financial crisis from 2007 to 2009 has not really been fixed. In fact, Deutsche Bank also, as you know, holds the toxic assets from Credit Suisse, which last year was forced to merge to avoid bankruptcy. And there are toxic assets that are being hidden here. Now, one of the things that I want you to notice is that at that last quarterly report from the CEO of Deutsche Bank, okay, he basically said, despite more challenging environment, okay, notice the word, you got to parse these words. You have to read in between the lines. What the banks are saying is that, they delivered a post-tax return on equity above 10%. Well, big whoop, right? Demonstrating strength. So they're super happy, they're saying. And this puts them on track to meet their 2025 targets, which is not very high, which is to continue to show the stock market and their shareholders and the bank customers that they are solvent. Okay. So they are raising capital distributions to shareholders beyond 2025. So, this is something that you need to kind of worry about in terms of when banks are one of their things that they continue to talk about is shareholder distributions and beyond 2025. It's parsed safely when they start talking about this is basically saying that, yeah, we have challenges. The banking environment is challenging with the rising rate environment, inflation, as well as kind of the collapse in the global markets. So that was kind of my intro. Here's the disclaimer. Pause it, read it. If you agree, please move forward and make sure that you follow me on x.com/galaxy.market and also follow us on YouTube. So let's get right to the point why I'm doing this video. It's going to be very, very short. And basically, the Wells Fargo and JP Morgan Chase and everybody else, they're beginning to fall off the cliff. And, a couple of the people that I follow, especially the Coastal Journal and everybody else, is beginning to see, or they have seen it for a long time. They sound just like me, if you think about it. Is that the banks are insolvent, and they're pointing out the same thing that we're looking at. These toxic assets are being hidden and not being marked to market. This is what happens when you repeal the Glass-Steagall Act, basically enacted after Great Depression to separate out commercial banks from investment banks. But all the banks, in order to keep the illusion that banks are strong, they merged them together. And this all came under Bill Clinton's administration, which set the stage for the financial crisis. And the financial crisis never solved anything except some obscure guy going to jail for some insider trading BS. But, nobody actually was punished. In fact, they got rewarded for this. And if you look at like Goldman Sachs, Lloyd Blankfein, ended up being a billionaire after that financial crisis on the backs of the taxpayers. But that's not what I'm talking about. But I have to get, you know how I feel about the banks in general, especially our esteemed Federal Reserve Bank, which is not federal, and there's nothing in reserve other than paper. But regardless, right now, I just want to point out to you, Deutsche Bank has enjoyed a run-up post-earnings based on that statement that we talked about previously. So the Deutsche Bank on the weekly, very, very negative divergence on the RSI, despite the fact that we gapped higher. We're basically seeing a negative divergence. This right here, this chart pattern, since the gap higher, is a very bearish formation. It's just kind of this, what I call the turtle's hump right here. But really, we topped out here. We're now forming this rounded top with these two rather interesting candle formations. Yes, the volume is lacking, but it's been basically increasing on the sell side. Okay, mind all these gaps that it's going to come up from. Okay, all of these gaps are significant, and it's going to be playing a role shortly. And if you haven't noticed, and as I've said in my previous videos, that we have hit the upper end of the long-term SPY uptrend line ever since the Trump pump since after May. We've been going up non-stop. Those are on the backs of printed money. Okay, nothing more, nothing less. And I don't care about tariffs. I don't care about all of these things. I'm going to tell you what I see on the chart. Here's the 50-day moving average. Here's the 200-day moving average. We are significantly off of the 200-day moving average. So there's going to be a corrective action that's going to bring it down at least to here. But mind all these little gaps. And these gaps will definitely get filled on the way down. I mean, there's a significant gap. And I believe Deutsche Bank is an insolvent bank to begin with. More importantly, let's look at the MACD is forming a death hook, and the MACD histogram is on a negative divergence. It's getting weaker as we speak. This is like a prime area in which if there's something going on, given the market's action, and if there's something going on within the banks and they can't hide the fact that they're insolvent, this is the place that you want to be if you're short-minded. Not financial advice, but this is what I'm thinking, is that it's extended. It's now showing significant amounts of negative divergences to a point where I'm interested. Okay, so that's about it. Like us and follow us on YouTube and x.com. And if you want to work with me, please email me at coachbrandon@protonmail.com. Okay, otherwise, good luck out there. Hope this helps.